Welcome back to Talk Tickers, the show where we strip away the corporate PR and get straight to the mechanics of the market.
And we are cracking open the books today on Chevron Corporation, ticker CVX, for their fourth quarter of 2025.
And this one's interesting because it's not a straightforward story. We're recording this on Saturday, January 31st, 2026. The market closed yesterday.
Right, and the reaction was immediate. Chevron stock closed up 3.34%. Sitting at 176.90.
Which is a significant move for a supermajor. We aren't talking about a volatile tech stock here.
No, not at all.
A 3% pop implies a real shift in sentiment. But here's the thing that caught my eye. They missed on revenue. So why did the market reward a revenue miss with a rally?
Yeah, that's the key question. And it comes down to what I call vanity metrics versus sanity metrics. The revenue miss was tiny, like 0.6%.
Okay.
Came in at 46.87 billion. But that was almost entirely due to weaker crude pricing year over year. The smart money knows that's going to fluctuate.
So they look past the top line.
They look right past it. They care about execution. And that's where Chevron delivered a beat. Adjusted earnings per share came in at $1.52, which beat the consensus of $1.45.
So they were more profitable than Wall Street expected, even selling their product for less. That speaks to margin.
Exactly. But the number that really justifies that stock move, it's the cash flow from operations, CFFO. In Q4 alone, Chevron generated $10.8 billion in cash.
Wow.
That is just a massive amount of liquidity in 90 days. It proves their break-even price is incredibly low. They are a cash machine, almost regardless of where spot prices are.
And for the shareholder, that cash is the only thing that really matters. It's what funds the returns.
And they were aggressive on that front. They hiked the quarterly dividend by 4% to $1.78 per share.
Which is a great signal.
It's a huge signal.
Yeah.
And they hit the very high end of their buyback guidance, repurchased $3 billion of their own stock. So when you miss on revenue, but you hike the dividend and max out buybacks, you're telling the market, we don't need $90 oil to pay you.
Right. It springs confidence in the cash flow. But let's pivot to operations, because you can't just financial engineer these results forever. You have to actually get more oil out of the ground and do it more efficiently. Let's talk about the Permian Basin.
The Permian is the engine right now. They just hit a huge milestone there. Over 1 million barrels of oil equivalent per day.
1 million barrels a day.
It's a massive number. But you're right. It's not just about drilling more holes. The really critical insight from the call was about how they're doing it. It's about recovery rates.
Okay, so this is where we get into the chemical cocktails they mentioned. For our listeners who aren't petroleum engineers, break that down. What are they actually doing?
It's a big shift in capital efficiency. So think of an oil reservoir like a rigid, dirty sponge. When you first drill, you get the easy oil. But a ton of it just clings to the rock surface. It's sticky. What Chevron's doing is deploying these proprietary chemical surfactants.
Which are basically soaps, high-tech soaps.
That's the perfect way to think about it. It's like a high-tech soap that washes the oil off the rock deep underground, allowing it to flow into the well.
And does it work?
The data they shared is pretty wild. On new wells treated with these chemicals, they're seeing a 20% improvement in cumulative recovery over the first 10 months.
20%. That's massive. That changes the entire economic model of a well.
It changes everything. It flattens the decline curve, so you get 20% more product out of the same hole you already drilled and paid for. Your CapEx efficiency just goes through the roof.
And they're scaling this up.
Fast. In 2025, they did it on about 40% of new wells. This year, the target is 85%. And they're taking the tech from the Permian to the DJ Basin, even down to Argentina.
Okay, so that's the tech side. What about just old-fashioned cost cutting? They mentioned using AI in the supply chain.
Yeah, and this is where the industry is moving. It's not just about layoffs. They're using AI to analyze global prices for everything: steel, sand, equipment.
So the AI tells them what a fair price is.
Exactly. Instead of just relying on an old contract, it says, hey, based on raw material costs, you should be paying X for this pipe, not Y.
Yeah.
It gives them huge leverage in negotiations.
So you have this super efficient domestic engine humming along. But Chevron's a global company, and the rest of the world is, well, it's messy.
It's very messy.
We have to talk about Kazakhstan and the Black Sea. The war zone risk.
Right. The Tengiz field, or TCO, huge asset, but it's in a really tough neighborhood. They had a power outage that halted production for a bit.
Management said that was mechanical right, not a cyber attack.
Correct. purely mechanical. That's being fixed. The bigger issue, the one that normally terrifies investors, is the export route.
The CPC pipeline.
Yeah. The oil has to go through that pipeline to a loading terminal on the Black Sea. And in December, due to the conflict in the region, one of the 3 loading berths at that terminal was hit by a submarine drone.
Wait, a submarine drone strikes their primary export terminal. And the stock, as we said, is up. How does that make any sense?
It sounds totally backward, but it tells you something about diversification and risk. The market has already priced in that the Black Sea is a hot zone.
Okay.
What impressed everyone was the resilience. Even with a berth hit by a drone, they just kept oil flowing through the other ones. It proved their logistics can absorb a literal kinetic strike without a complete cash flow stoppage. A smaller company would have been toast.
The benefit of being a giant.
Yeah.
And speaking of diversification, that brings us to the Hess acquisition. That deal is closed now.
And it is the most critical piece of their future growth. Hess brings them Guyana. The Permian is efficient, sure, but Guyana is what we call high cash margin barrels.
Meaning the cost to get it out of the ground is super low.
Yeah. Incredibly low. So by integrating Hess, they aren't just adding volume, they're improving the average quality and profitability of their entire portfolio. It's a huge risk mitigator.
Let's stay in South America and pivot to Venezuela. For years, that asset was a zero, a write-off. Now they're talking about a 50% jump in output.
It's a massive turnaround. They're at about 250,000 barrels per day right now. The guidance on the call was pretty aggressive. They see a path to ramp that up by half over the next 18 to 24 months.
But the pushback is obvious. Why would you pour money into Venezuela? The political risk is off the charts.
And that's the nuance. They stress this. They're using a self-funding model. Chevron isn't wiring billions of fresh dollars into the country.
So how does it work?
The cash generated by the joint ventures inside Venezuela pays for all the maintenance and ops. The cash left over is used to pay down old debts that Venezuela owes to Chevron.
So the oil pays for its own extraction, and Chevron gets paid back on old loans.
Correct. It's very, very low capital risk for shareholders. They're basically recovering bad debts in the form of crude oil, which they then ship to their own refineries on the U.S. Gulf Coast.
That's a perfect segue. There was this mention of a Trump effect in the Middle East.
Yeah, this was interesting. They said they've seen a big uptick in inbound calls from Middle Eastern countries since President Trump's recent visit to the region.
And why is that?
Historically, Chevron's been underweight in the Middle East because the fiscal terms, the tax rates, the profit splits, they just weren't very good.
The countries wanted too big of a cut.
Exactly. But the commentary suggests that these nations are now offering better terms to specifically attract American investment. They're ready to deal, and Chevron is listening.
So it feels like they're positioned everywhere. Okay, let's move downstream. We've talked about getting the oil. Now let's talk about refining it. The situation in California is unique.
It's the classic last man standing strategy. You read about competitors closing their California refineries because of the tough policy environment. Chevron is staying.
Which seems counterintuitive.
But it's cold, hard economics. As competitors leave, the supply of gasoline and diesel in the state gets tighter, but demand isn't falling nearly as fast as that supply is vanishing.
So by being the last major player, they get more pricing power.
100%. It creates a regulatory moat. And if you look at their downstream earnings, $823 million, up from a loss last year, that strategy is clearly paying off.
And their Gulf Coast refineries are key to this whole story.
Right.
Especially with that Venezuelan crude coming in.
That is the crucial link. Not all oil is the same and not all refineries are the same. This really sets up the structural advantage they have right now.
Okay, let's bridge that directly into our high-octane segment. This is where we take all this data and try to build a trade idea out of it.
Let's do it.
And the standard disclaimer applies. This is absolutely not financial advice. We're not your advisors. We are just parsing public data for educational purposes. So please do your own homework.
Always.
All right, what's the trade you're seeing in this setup?
I'm calling this one the heavy light spread widower.
Okay.
Or, if you want a more punchy title, the dictator discount arbitrage.
Huh. I like that. Walk us through the setup.
Okay, so here's the reality. We have Venezuela potentially ramping up production by 50%. That Venezuelan crude is what we call heavy and sour. It's thick, like sludge.
It's the cheap stuff because it's so hard to process.
Exactly. You need really complex, expensive refineries to handle it. At the exact same time, the Permian is pumping record amounts of light, sweet crude, easy stuff to refine.
So you have a flood of heavy oil from the south, And a flood of light oil from Texas.
Correct. And when that heavy oil floods the market, its price drops relative to light oil. The spread between the two just blows out. Heavy oil gets dirt cheap.
So how do you trade that? It's not just buying oil futures.
No, you trade the refiners themselves based on their hardware. The play is to go long complex refiners and short simple refiners.
Explain that. Why does the complex refiner win?
A complex refiner, like Chevron's Pascagoula plant in Mississippi, is built to chew up that cheap, heavy Venezuelan sludge. They buy the raw material at that dictator discount, but they sell the finished gasoline at the global market price.
So their input costs crash while their selling price stays high.
And their margins explode. They just capture that whole spread.
Yeah.
Meanwhile, a simple refiner can't process the sludge. They're forced to buy the more expensive light crude, so their margins get squeezed while the complex guys are printing money.
That is a nuance most people would miss. It's not just oil is up.
Yeah.
It's about the specific grade of crude and the steel that can process it.
Exactly. And Chevron is perfectly positioned. They're shipping that Venezuelan crude right to their own system. They win on the extraction and then they win again on the refining spread. It's a double dip.
Fascinating stuff. So to bring this full circle on Chevron's quarter, it wasn't the flashiest report on the top line.
Not at all. They missed revenue, but the execution, all the boring stuff was just undeniable.
They're proving they can walk and chew gum at the same time.
Yeah, they're cutting costs with AI, getting more oil with chemistry, integrating a massive acquisition, navigating literal drone strikes, and still paying you $1.78 a share every quarter.
In a volatile world, maybe boring execution is the most valuable asset. The market's reaction certainly seems to confirm that.
I think that's the big takeaway.
That is the book on CVX for this quarter. Thanks for diving in with us.
Always a pleasure.
And remember, keep your stops tight and your spreads wide. We'll see you on the next deep dive.